I have a hobby horse, which I'm not sure I've tried on you before, but I've tried on a lot of guests. And that is that I am a big fan of listed private equity structures, particularly in the UK, we have investment trusts, and in continental Europe, they're called investment companies. And I've asked several people, what are the advantages of the Evergreen, unlisted Evergreen, over these listed investment trusts? Because for me, you get all the kind of exposure that you would get, but with greater liquidity. I'm talking about as an individual investor rather than an institution, because there's not a huge amount of liquidity even in the listed funds. But you get everything that you get in the Evergreen, but you get all of the advantages of the public market. And so all things being equal, as an unconstrained investor, I would personally always go with a listed option.
So it makes sense. Very few things you might need to consider. The first one is the noise from the stock exchange. The discount on the NAV that you're going to have to withstand is going to vary over time. Sometimes it will be in your favor when it's going to decrease, and sometimes it's going to unfortunately go against you when it's going to increase. So that's something you don't have in the Evergreen. In the Evergreen, you enter at NAV, you get out at NAV, right? And so basically your performance is the difference between the two. But the variability of the NAV is much lower than the variability of the stock price of a listed structure. So in that sense, for a lot of people, this predictability and the fact that it mostly goes up is a very positive feature. Listed private equity, unfortunately, and it's been studied quite a few times, has this very strong correlation with the evolution of the indexes of stocks in general. It's above 0.7. And so it means that essentially you buy into something you're already exposed to. Because your reasoning stands if you only do one investment, but in a portfolio context, listed private equity doesn't diversify much your exposure to listed stocks. And that might be one of the reasons why you want to invest in private markets. So in that sense, Evergreen is a kind of anchor. It stabilizes the boat, and then you get this progression of NAV. Then you have like this range of possibilities. One is listed private equity, one is unlisted Evergreen, and another one is the closed end, right? So depending on your expectations, your sophistication, and your time horizon, you can choose which one you prefer.
I completely buy all that, and it's great that there are different options available to people. I think, though, that I would still prefer listed private equity because the advantages that you have outlined, for me, they feel a little bit like bureaucratic advantages that are tinged with modern portfolio theory that views risk more as volatility that can be diversified through uncorrelated assets rather than just the risk of not getting the return that I want to get. And if over time, a listed private equity company will be highly correlated with the performance of the underlyings. Do you see a situation where we see some kind of strange hybrid between private markets and publicly trading markets where more and more people can get a small piece of these very, very large kind of unicorn businesses that have never known the public world?
Private and public markets are living in symbiosis, right? And if one tries to do the work of the other one, it's not adapted. I'm not comfortable about the idea of trading shares without the equipment of the listed markets. So information, transparency, fairness of treatment of all investors and all of that, because the reason why they exist today is because we learned the hard way in the past that it was necessary. So if you try to dismantle all of that, you actually pile up risks, and I'm not sure it's very healthy. The other thing is that there is a discipline in the listed market which is very healthy. Ultimately, I mean, we can criticize, excesses, reactions, maybe sometimes some herding effects, which have been documented by the academic literature. But ultimately, it's a very rigorous, disciplined process, and it has a lot of virtues. And if private markets somehow try to do everything, I'm not sure it will be very healthy on the long term. the stock exchange is necessary, even just for that, to be able to value assets. And we know that, for example, fund managers are very good at it, but ultimately the real true discipline comes from an IPO or a trade sale, which is usually from companies which themselves are listed, for example, or have a connection to the listed markets, which create this kind of intrinsic discipline. So if you want to trade shares from a non-listed company, the question is, do you have the relevant information to do it? And my educated guess is that very often it's not the case unless you have access, for example, to the shareholders agreement. Because what we're talking about is shares usually which comes from the venture sector, right? If you're in a buyout, you're not going to trade 5% of your company on the secondary market of whatever non-listed shares that we want to consider. You sell the company or you don't. So it's a venture business then. But then if you don't get access to the shareholders agreement, you don't know what effectively you're buying, right? You think it's a tomato, but there are different kind of tomatoes. And if you want to do a sauce or, a salad, maybe you want to consider different kinds of tomatoes.
And the governance won't be as strong if there's not that oversight.
Yeah. And the price per share varies a lot. If you have a preferred share or a common share, it's not the same share. It's not valued the same. It doesn't have the same rights, etc. So then you start to enter a very, very challenging environment. I had a call with a friend recently, and there was this idea that maybe there should be a trading venue for the private market shares so that people can, exchange, etc. And I try to explain it's a plumbing issue here. And the plumbing is not the issue. We have the technology. We have been mastering it. It's really well done. Brilliant people have set it up. Listed markets work. It's really brilliant, right? It's an information issue. As long as we don't solve the information issue, then there is no point of trying to do that because it's a source of problems.
Right.
And information costs a fortune to be produced. That's why we do due diligence. It takes 6-9 months. We have extremely brilliant people doing it, that it costs a lot of money. And we do it once, right? We don't do a due diligence every quarter.
Yeah.
No, we don't. And so you get the reporting, but the reporting is an update on the due diligence that you've been performing. And we know that after a while, regardless the time we spend, the boards we attend, we are still losing ground in terms of quality of information. And then there will be a point where we need to sell this asset. And the person on the other side doing then the due diligence will discover things that we didn't even know, even though we did our due diligence and we sat on the board and we read the monthly or quarterly report. This discipline of the listed world is great because it produces high quality, frequent information, which is verified by a lot of people. And this is very healthy, and that's why we need to keep it.